Assalamualaikum. My name is Muhammad Hafizi bin Ahmad Fuzi. My student ID is 52507558 Today, I will be presenting an analysis of how government debt interact with key microeconomic variables in Malaysia, specifically government debt, aggregate demand, aggregate supply, and the saving investment dynamic. This presentation draws how our recent report on Malaysia macroeconomic management, particularly looking at the period following the COVID-19 pandemic and the government recent policy response. We will explore this interconnection over the next 10 minutes, including with policy recommendation for sustainable economic management. Let's begin by understanding what we mean by government debt. Essentially, it's the accumulation of past borrowing when the government spends more than is collect in revenue. In Malaysia, we distinguish between internal and external debts. Internal debt is borrowed from within the country. Think of Malaysian government security purchase by our local bank, EPF and KWAP, KWAP. This is generally considered safer because we owe money to ourselves, so to speak. External debt, on the other hand, involve borrowing from foreign entity like when Malaysia issue bond internationally or take loan from institutions like the World Bank or IMF. As mentioned in the IMF 2025 Article 4 consultation, external debt exposed to us exchange the rate risk. What caused Malaysian debt to rise? The more significant factor was the COVID-19 pandemic. We had to spend heavily in stimulus package to keep business afloat and support household. But there are also structural issues. We have been running fiscal deficit for years, meaning spending consistently exceed revenue. The subsidy burden is substantial. Diesel, electricity, and RON 95 petrol subsidies cost billions annually. And we continue to spend the development, the third Malaysian plan allocate RM 430 billion for infrastructure and long-term projects. All this contribute to our national debt. How does government debt affect aggregate demand in the short run? When the government run a fiscal deficit, spending more than its collect, it inject money directly into the economy. This is the classic Keynesian stimulus approach. Think of it this way: when the government builds a new highway, is employed construction workers, buy material, and pay contractor. These recipients then spend the income on goods and services, creating a multiply effect that ripples through the economy. This is exactly what happened during the pandemic. Our stimulus package prevented a much deeper recession by supporting aggregate demand when private consumption and investment collapsed. However, there are concerns called crowding out. When the government borrows heavily, it competes for funds in financial market, potentially pushing up interest rate. Highest rate make it more expensive for businesses to borrow for investment. This is why Bank Negara Malaysia carefully manage the overnight policy rate, OPR, currently maintained at 3% since May 2023 to strike a balance. Malaysia's recent approach has been interesting. Since 2022, we have been gradually consolidating, reducing the fiscal deficit from 6.4% of GDP in 2021 to a target of 3.8% in 2025. The diesel subsidy rationalization in June 2024 was carefully managed with targeted cash transfers to avoid a sharp contraction in aggregate demand. This shows sophisticated understanding what withdrawing stimulus too quickly can harm recovery. While debt finance spending boosts aggregate demand in the short run, persistent high debt can constrain aggregate supply in the long run. This is crucial for Malaysia as we aim to escape the middle income trap. Let me explain the crowding out mechanism more thoroughly. When the government consistently borrows large amounts, it absorbs a significant portion of available funds in financial market. This puts upward pressure on interest rate for businesses considering new factories, equipment, or technology. Highest borrowing costs may delay or cancel investment projects. Over time, this means slower capital accumulation. We have fewer machine factories and infrastructure than we could have had. Since capital stock is a key determinant of productivity, capacity, long-run aggregate supply suffer. Labor market are also affected. Debt servicing, Malaysia spent about RM 46 billion on interest payment in 2024. Reduced fiscal space for spending on education, training, and healthcare. Yes, the third Malaysian plans raising the ceiling agenda emphasizes exactly this. Increasing economic complexity and moving up the value chain requires a skills, productive workplace. If debt payment crowd out investment in human capital, we undermine our own long-term growth potential. Productivity is the third channel. Advanced economics invest heavily in research and development, technology adoption, and innovation. When government budget are strained by debt servicing, funding for these productivity enhanced areas may be constrained. Malaysia concern about the middle income trap reflect this. We need to shift from being efficient producer to innovative creator. However, there are positive strong emerging. The diesel subsidy reform in 2024 demonstrate how reducing wasteful spending can free up resource for productive use. The government is redirecting safe subsidy funds toward development expenditure that can boost long-run aggregate supply. Let's now consider as saving and investment the foundation of long-term economic growth. Saving the simply income that is not spent on consumption. It comes from household business. And when the government runs a surplus, investment in economic term mean purchasing new capital good, not financial investment like stock. These include factory, machinery, computer system, infrastructure, and even education that improve human capitals. The relationship between saving and investment is fundamental. In a closed economy, all investment must be financed by domestic saving. In an open economy like Malaysia, we can also borrow from abroad, but that creates external debt obligation. Why does this matters? Because investment drive long-run growth. When business invest in new machinery, workers becomes more productive. When the government invests in road and port, transportation costs fall and efficiency improve. When we invest in education, we develop human capital that can innovate and adapt. All this shift the long run aggregate supply curve to the right. The economy can produce more at every price level. For Malaysia, this is critical. Our GDP calculation through the expenditure approach, including investment as a key component. The third Malaysian plans RM 430 billion development allocation represent public investment aims at raising the country's productive capacity. Sorry. But we also need robust private investment. That's where innovation, job creation, and dynamic growth come from. The challenge is ensuring that government debt doesn't crowd out, out the private investment we desperately need. Drawing from Malaysia recent experience and macroeconomics theory, I'd like to propose several policy recommendations for managing government debt while maintaining health levels of aggregate demand and aggregate supply. In the short to medium term, gradual fiscal consolidation is essential. The diesel subsidy reform in June 2024 provide an excellent template. Rather than abruptly cutting subsidies, the government implements targeted cash transfer to logistic companies through fleet card and strengthened support from vulnerable households. This approach minimizes inflationary impact the achieving fiscal saving. The next major test will be around 95 petrol subsidy rationalizations plan for mid-2025. This should follow the same careful targeted approach. Expanding the tax base through SST broadening is preferable to sudden spending cuts that could harm aggregate demand. Crucially, we must protect development expenditure, the spending that builds our future productive capacity while rationalizing operating expenditure. Targeted social protection is non-negotiable. The PADU central database must be strengthened to ensure cash transfer reach those who need them. When we implement reform, the B40 household must be shielded from disproportionate impact. This maintains social cohesion and political sustainability for reform. Monetary fiscal coordination is vital. Bank Negara Malaysia current data depends approach, maintaining OPR at 3% while ready to tighten if needed, provides stability. If fiscal measures triggers broad inflammation, Bank Negara Malaysia must be prepared to act. For the long term, we must enhance productivity and potential output. This means investing in education, research and development, and technology, precisely what we raising the ceiling agenda under the third Malaysian Plan Invention. Economic complexity doesn't happen by accident. It requires deliberate investment in high value added sector. Strengthening fiscal institutions through full implementation of the Fiscal Responsibility Act 2024 is crucial. Clear debt and deficit limit, transparent reporting and splints management will build credibility and reduce risk premium. Finally, promoting private investment requires a stable macroeconomic environment when business can predict interest rate, inflation, and policy direction, they invest. By reducing crowding out through prudence, borrowing, and creating incentive for productive investment, we can ensure that both public and private investment contribute to long-run growth. The diesel reform of 2024 shows it's possible. Politically difficult reform can be implemented successfully when carefully calibrated. Malaysian ability to navigate these trade-offs will determine whether they will truly escape the middle income trap and deliver sustainable prosperity for all citizens. So let's bring this all together. We have talked about government debt, and the conclusion is clear. It is double-edged sword. The crisis is an essential tool to stabilize the economy and protect livelihood. But if it becomes a persistent habit, it can blunt that we same economy, crowding out the private investment we need to the future. Because at its core, sustainable growth is not built on debt. It is built on saving and investment. That's how we expand our productive capacity. The good news, we know that what's work policy calibration is everything. It is not about brute force austerity. It's about smart, gradual, and targeted reform. We saw this recently with Malaysia, this subsidy reform in 2024. It was a difficult trade-off, but by protecting vulnerable households, they proved that strong reform can be managed successfully. So what's the path forward is required political courage to implement this two reform. It required a laser focus on protecting the most vulnerable, and above all, it's required a long-term vision and unwavering commitment to boosting productivity and escape the middle income trap once and for all. Thank you for your listening to my presentation. Assalamualaikum.